Hey everyone, and welcome back. We're diving deep into something that might be on a lot of people's minds, actually, how bankruptcy, how it shows up on your credit report and what you can actually do about it.
hmm
We're looking at this article, How to Get Bankruptcies Removed from Your Credit Report in 3 Steps, published December 17th, 2024.
Okay.
So if you're ready to unpack this pretty complex topic and walk away with some solid insights, well, let's jump right in.
Yeah, it's interesting, how much weight people give to this idea of removing a bankruptcy.
Yeah.
The truth is, it's not like an embarrassing photo you can just, delete. It's
Yeah.
more like, a significant event
Right.
in your financial history, and understanding that is key.
Right. It's not about erasing the past, but
Yeah.
understanding its impact.
Exactly.
So let's start with the basics. How does filing for bankruptcy actually affect your credit score?
Well, imagine your credit score is like a report card
Okay.
that lenders use to gauge your financial reliability. Payment history is like the star student, carries the most weight.
Yeah.
And when you file for bankruptcy, it's like getting a big fat F in that category.
Ouch, that's got hurt. The article mentions a potential drop of up to 200 points,
Yeah.
which seems extreme. Why such a massive hit? Is it purely about the missed payments, or is there something more to it?
It's a bit of both. Statistically, bankruptcy is a strong predictor of future default, so the algorithm reflects that. But there's also a psychological element at play.
Okay.
Lenders see bankruptcy as a sign of risk,
Yeah.
a red flag that makes them hesitant to extend credit.
So it's not just about the numbers, it's also about how lenders perceive bankruptcy.
Exactly.
Speaking of perceptions, this article claims to have a 3-step secret to getting bankruptcies removed. Is that even realistic?
Not exactly. You can't magically erase a legitimate bankruptcy from your credit report.
Right.
It's public record.
Okay.
What you can do is dispute any inaccuracies
Okay.
or errors in the filing. That's where those 3 steps come in.
Okay, so let's break down those steps.
Yeah.
The article talks about things like re-aging accounts
Yeah.
and even someone using your identity to protect assets in bankruptcy. Those sound pretty complicated.
Let's start with re-aging.
Okay.
Imagine an account that was discharged in bankruptcy, suddenly reappearing on your report as active debt.
Wow.
That's re-aging, and it's a huge problem.
Wow, talk about adding insult to injury. And the identity theft scenario, that's straight out of a nightmare. How does that even work?
It's a less common,
Okay.
but serious issue. Someone facing financial trouble might try to hide assets by fraudulently listing you as an owner.
Oh, wow.
If they file for bankruptcy, you could end up with a bankruptcy on your record
Oh, my gosh.
that you had nothing to do with.
That's scary stuff. So first step,
Yeah.
determine if the bankruptcy was even yours to begin with. Then what?
Step 2 is where the Fair Credit Reporting Act, or FCRA, comes in.
Okay.
If you find an error, you file a dispute with the credit bureau. The FCRA gives you the right to have your report corrected.
So no more sweeping things under the rug. But the credit bureaus are notoriously slow. How long does this process usually take?
The FCRA mandates that credit bureaus investigate and resolve disputes within a reasonable time frame, typically 30 to 45 days.
That's good to know. And what about the third step? Is it just a waiting game?
Exactly. If your dispute is valid, the credit bureaus are obligated to correct the information. If the bankruptcy is legitimate, you'll need to wait for it to naturally cycle off your report.
Okay.
But remember, while you're waiting, you can start taking steps to rebuild your credit.
Speaking of which, how long does a bankruptcy actually stay on your credit report? I know there's a difference between Chapter 7 to Chapter 13, right?
You're right, there is a difference. Chapter 7, which involves liquidating assets, typically stays on your report for 10 years. Chapter 13, which involves a repayment plan, generally remains for 7 years.
7 years is still a long time. But regardless of which chapter it is, it sounds like we need to talk about rebuilding credit. This article mentions 5 strategies, and one that caught my eye was secured credit cards. Can you explain how those work, and are there any downsides?
A secured credit card requires a cash deposit as collateral,
Okay.
which usually becomes your credit limit.
Okay.
It's a way to demonstrate responsible credit use and rebuild your score.
So it's like training wheels for credit.
Yeah,
But are all secured cards created equal? Are there things listeners should look out for?
that's a great question. Not all secured cards are the same. You'll want to compare fees, interest rates, and features like rewards programs.
Okay.
Some even offer a path to graduating to an unsecured card,
Okay.
which means getting your deposit back.
That's good to know. It sounds like there's a lot more to unpack when it comes to rebuilding credit. But before we dive into that, I'd love to hear your take on something. The article focuses on individual actions, but how much responsibility do lenders have in helping people rebuild after bankruptcy? Do you think their practices are fair, or could they be doing more?
That's a complex question with no easy answers. Some argue that lenders are simply mitigating their risk.
Okay.
Others believe they could be more flexible and supportive. It's a debate worth having, and we'll certainly touch on that in part 2 of our deep dive.
Okay, so stay tuned for that. Before we wrap up part 1, though, let's address a few common questions the article brings up.
Okay.
First, can your credit really recover after bankruptcy?
Absolutely. It takes time, effort, and a strategic approach, but recovery is definitely possible.
That's reassuring. Another question.
Hmm.
What's the real difference between Chapter 7 and Chapter 13? We touched on the duration on your report, but what are the key factors someone should consider when choosing between them?
It comes down to your individual financial situation and goals.
Okay. Chapter 7 might be suitable for someone with limited assets and income, while Chapter 13 could be better for someone who wants to keep their home or car.
So it's not a one-size-fits-all situation.
Right.
And finally, the article asks, do bankruptcies automatically fall off your credit report?
Yes, they do.
Okay.
Once that 7 or 10-year period expires, the bankruptcy is automatically removed. You don't have to do anything.
That's good news. It gives people a light at the end of the tunnel. All right, that's a wrap for part 1 of our deep dive.
Okay.
We've laid the groundwork, but we've got more to explore. In part 2, we'll dig deeper into the rise in bankruptcy filings and its broader implications.
Stay tuned. We'll be analyzing those socioeconomic factors, lender responses, and what it all means for the future of credit. Welcome back to our deep dive into bankruptcy and credit reports. In part 1, we explored the mechanics of how bankruptcy impacts your credit score and those initial steps you can take towards recovery. Now let's zoom out and look at the bigger picture. Right, because this isn't just an individual issue. The article mentions a 16% jump in bankruptcy filings from 2023 to 2024. I'm curious, what are the driving forces behind this surge? Is this a temporary blip or a sign of a deeper economic shift?
That's the million-dollar question. The article points to the rising cost of living as a major factor. Think about it. Inflation eating into everyone's budgets, interest rates making debt more expensive. It creates a pressure cooker environment for many households.
It's like a domino effect, isn't it?
Yeah.
One financial setback can trigger a cascade of problems. And I imagine the pandemic's lingering effects aren't helping either.
Absolutely. We're still seeing the ripple effects of job losses, income reductions, and depleted savings from that period. It's created a vulnerability that many haven't fully recovered from.
So it's a perfect storm of economic challenges converging at once. But how does this rise in bankruptcy filings actually impact the broader economy? What are the ripple effects beyond those directly filing?
Well, think of it like a spider web. Bankruptcy doesn't just impact the individual, it sends vibrations throughout the entire system. It affects lenders, investors, even the housing market.
Okay, let's untangle that web a bit. How are lenders feeling the pressure from this surge in filings?
When more people file for bankruptcy, it essentially means lenders are less likely to get the money they loan back. It's a loss for them. So naturally, they become more risk-averse. We're seeing tighter lending practices, higher interest rates, and overall less access to credit.
So it's a self-preservation tactic. They're trying to protect themselves from further losses, but it also makes it tougher for people to get back on their feet, doesn't it?
That's the unfortunate catch-22. It becomes a vicious cycle. And it's not just lenders feeling the heat. Investors who hold bonds or securities backed by loans are also watching nervously.
I can see why. If the underlying assets are less likely to perform because of increased default rates, it creates uncertainty and volatility in the market.
Exactly. And as we discussed earlier, the housing market isn't immune either. When people file for bankruptcy, they might be forced to sell their homes, increasing supply and potentially driving down prices.
It's fascinating how these seemingly disparate parts of the economy are actually interconnected. Speaking of connections, in part 1, we talked about how lenders might bear some responsibility for helping people rebuild after bankruptcy. Are there any specific practices or policies they could implement to make a difference?
That's a question that's sparking a lot of debate right now. Some argue that lenders should offer more flexible repayment options or financial literacy programs to help borrowers avoid default in the first place.
It makes sense, right? Proactive measures that address the root causes rather than just reacting after the fact. But what about those who are already in the thick of it, those facing the emotional weight of bankruptcy? The article doesn't touch on this much, but I imagine it's a significant burden.
It absolutely is. Filing for bankruptcy is more than just a financial event. It's a deeply personal and often traumatic experience. It can trigger feelings of shame, failure, even isolation.
It's like a financial and emotional earthquake. What advice would you give to someone struggling to cope with the emotional fallout of bankruptcy?
First and foremost, understand that you're not alone. Bankruptcy is more common than people realize, and it doesn't define you as a person. There's no shame in seeking help, whether it's from friends, family support groups, or a therapist.
It's about acknowledging those emotions and finding healthy outlets.
But beyond talking, are there any practical steps someone can take to regain a sense of control and start rebuilding their life?
Absolutely. Regaining control often starts with small but consistent steps. Creating a realistic budget and sticking to it can empower you to make informed financial decisions. And remember, self-care isn't a luxury, it's a necessity. Engaging in activities that bring joy, reduce stress, and promote well-being is crucial during challenging times.
It's about nurturing your mental and emotional health alongside your financial recovery. And as you said earlier, bankruptcy isn't the end of the road. It's a chance to learn, adapt, and build a more resilient financial future. Exactly. And that resilience often comes from knowledge and awareness. Speaking of which, remember how we talked about the potential for identity theft related to bankruptcy earlier? Let's delve into that a bit deeper.
You're right. That's a chilling thought. To recap, someone could use your identity to protect their assets during bankruptcy proceedings. But how do you even spot that kind of fraud, and what can you do to protect yourself?
The key is vigilance. Regularly reviewing your credit reports from all three bureaus is crucial. Look for any unfamiliar accounts or inquiries you didn't authorize. And consider using a credit monitoring service like LifeLock Ultimate Plus, which can alert you to suspicious activity in real time.
It sounds like having a security system for your financial identity. But those services can be expensive, especially for someone already facing financial hardship. Are there any free or low-cost alternatives?
You're right, cost is a factor. You can get free annual credit reports from annualcreditreport.com. Setting up fraud alerts with the credit bureaus is also free. And there are budgeting apps and resources that can help you track your finances and spot irregularities.
So there are options for every budget. And remember, if you do spot something fishy, don't hesitate to file a dispute with the credit bureaus. The Fair Credit Reporting Act is there to protect you.
Absolutely. Knowledge is your best defense. Speaking of knowledge, let's circle back to those credit building strategies we touched on earlier. One that often raises questions is becoming an authorized user on someone else's credit card.
Right, the piggybacking strategy. It sounds appealing, especially for someone with limited credit history. But are there any potential downsides or ethical considerations?
It's a strategy that can be very effective, but it's crucial to approach it responsibly. Make sure the primary cardholder has good credit habits and understands that you're using their account to rebuild yours. Transparency and communication are key to avoid any misunderstandings or damage to their credit.
And it's essential to remember that becoming an authorized user is just one piece of the puzzle. It should be part of a broader strategy that includes budgeting, tracking spending, and building good financial habits.
Precisely. Building long-term financial health takes a holistic approach. Now, before we wrap up part 2, I want to address something we touched on earlier, the psychological impact of bankruptcy. We talked about coping strategies, but how do we move beyond just surviving and start thriving after such a setback?
That's a great question. It's about shifting the narrative from victim to victor, isn't it?
Exactly. It's about reclaiming your financial power. And part of that is understanding the system, the rules of the game, and how to play strategically. That's why we're here diving deep into these topics.
Knowledge is power, and we're all about empowering our listeners. Now, before we move on to part 3, I want to pose a question to you and our listeners.
Yeah.
What if we reimagine the credit scoring system altogether? Is there a more holistic and equitable way to assess financial responsibility?
That's a provocative thought. It challenges us to think beyond the existing framework, and that's precisely what we'll be exploring in part 3. Stay tuned as we dive into potential alternatives and imagine a future where credit scoring is fairer and more inclusive.
Welcome back to the deep dive. We've covered a lot of ground, from the nitty-gritty of credit scores to the broader economic forces at play.
Right.
But in this final part, I want to shift gears and get a little philosophical.
Okay.
We've talked about practical steps and systemic issues, but ultimately it all boils down to this. What does financial well-being really mean?
Yeah, that's a good question. It's more than just, numbers on a spreadsheet or a bank account.
Yeah.
It's about feeling secure, empowered, and in control of your financial life.
Exactly. And that brings us back to the question we posed at the end of part 2.
Yeah.
What if we just reimagined the credit scoring system entirely?
That's a bold idea, but I think it's one worth exploring. The current system, for all its complexity, is still pretty one-dimensional.
Yeah.
It mainly focuses on past behavior, did you pay your bills on time?
Mm-hmm.
But it doesn't necessarily capture the full picture of someone's financial health or their potential.
Right. It's like judging a book by its cover. So if we were to start from scratch, what would a more holistic and equitable credit scoring system look like? What factors should it consider?
Well, imagine a system that not only looks at payment history, but also factors in things like income stability savings habits and even educational attainment.
Interesting. So instead of just focusing on debt, it would also acknowledge those positive financial behaviors and potential.
Exactly. It could even incorporate alternative data sources like rental payment history or utility bill payments to give a more comprehensive view, especially for those who might not have a traditional credit history.
I can see how that would be particularly beneficial for people new to the credit system or who have been excluded from those traditional banking services.
Right.
But wouldn't this kind of system be incredibly complex to manage?
It would definitely require sophisticated technology and careful consideration of data privacy,
Yeah.
but the potential benefits in terms of financial inclusion and fairness are huge.
Yeah. It's about leveling the playing field and giving everyone a fair shot at achieving financial well-being. Speaking of fairness, one thing that keeps coming up for me is this. Is the current system inherently biased against certain groups or demographics?
That's a sensitive topic,
Yeah.
but an important one to address. Studies have shown that credit scoring models can inadvertently perpetuate existing inequalities. For instance, factors like zip code or occupation, which can be proxies for race or socioeconomic status, might unfairly influence credit scores.
That's concerning. So it's not just about creating a more inclusive system, but also ensuring that it's free from those biases that could further disadvantage marginalized communities.
Absolutely. It's about building a system that promotes both fairness and accuracy. And that requires constant vigilance and a willingness to adapt as we learn more about the potential for bias.
Right. It's a work in progress for sure.
Yeah.
But these conversations are crucial to driving positive change. Now, before we wrap up our deep dive, I want to circle back to something we touched on earlier. The emotional toll of bankruptcy. We talked about coping mechanisms, but how do we move beyond just surviving and truly thrive after such a setback?
That's a powerful question. I think it starts with reframing the narrative. Bankruptcy doesn't have to be a mark of shame. It can be a catalyst for growth and transformation.
It's about turning a perceived failure into an opportunity for learning and resilience.
Exactly. It's about embracing the lessons learned, developing healthier financial habits, and building a stronger financial foundation for the future.
And remembering that financial well-being is a journey, not a destination. There will be bumps along the way, but with the right mindset and support, we can navigate those challenges and emerge stronger.
Beautifully said. And remember, knowledge is key. The more we understand about the system, the better equipped we are to make informed decisions and advocate for ourselves and our communities.
Well, folks, that brings us to the end of our deep dive into bankruptcy and credit reports. We've explored the technical aspects, the economic implications, and the very personal emotional journey. I hope you found this deep dive informative and empowering.
It's been a pleasure diving deep with you all. Remember, no matter where you are in your financial journey, you have the power to make positive changes and create a brighter financial future.
Thanks for joining us. And remember to keep those questions coming. We'll be back soon with another deep dive into a topic that matters to you. Until then, keep exploring and keep learning.
If this podcast helped you, don't forget to like, comment, and subscribe. Your support helps us keep making these videos. Thanks for watching.